Welcome, everyone. Thank you for joining us today. I'm 𝗖𝗽𝗶𝘁 Biniaz. I'm joined by 𝗖𝗽 Benesocky. Welcome, Ava.
Thank you, August. Hi, everyone. Thank you so much for being here. Today, we are joined by Allan Madan. He is a Master of Accounting at Madan Chartered Accountant Professional Corporation. Now, really quickly, I just want to let everybody know about Allan because he has some strong background. Allan is a CPA, a CA, and an international tax expert. He is a graduate of the University of Waterloo, where he earned a master's degree in accounting. So he has over 12 years of experience in public accounting. And one thing I really wanted to point out was Allan has completed parts 1 and 2 of the Canadian in-depth course, which is the most comprehensive tax training in Canada.
Great. And one more quick thing about Allan is that when we started our journey in this concept of apartment syndication and investing in the US in multifamily, we noticed that there wasn't a lot of resources. There was a lot of resources in the US, but there weren't a lot of resources here in Canada. So in my, this was a couple of years ago, in the research I was doing, I noticed that one place that there was some information was on Allan's YouTube channel, where he talked about cross-border taxation and implications of cross-border taxation and all the other information. So right away from day one on our journey, we noticed that Allan was the man.
So he was the man.
We're very glad to have him here. We're very glad to work with him and excited to have this webinar. So
welcome, Allan.
Welcome, Allan.
Thank you for inviting me. You've inflated my ego. I'm going to tell my wife what you said, but I don't think she's going to buy it. but I appreciate it. I want to walk through a couple of structures with you, and thank you for sharing that information as an intro. I also am a real estate investor in the United States. And at one point, I owned about 200 doors myself. And now I've gone on to other investments, but it's great. Multifamily investing, commercial investing, whatever it is you like in the United States, as long as it's a good investment, you will make money. So I'm just going to share my screen if I can here.
Yeah, of course. I think you can already. You are.
I can already? I can. I'm going to click on share screen and share.
Yes, I believe so.
Fantastic. There you go.
Okay. All right. So let's look at this first diagram. In this diagram, I'm showing you a way that you could purchase US real estate without being double taxed. So you'll see that there's 3 components here. On the top, I have a Canadian individual investor. That individual will set up this blue triangle, which is a US limited partnership. The US limited partnership has 2 partners. The first is a Canadian individual, you, owning 99% of the partnership. By definition, a partnership has to have at least 2 partners. So that's why we create a general partner, which is represented by the orange box. The general partner owns a 1% partnership interest in the partnership. The general partner is usually a US LLC, and that also provides you with liability protection. As an individual, you never want to be a general partner because the risk is on you if things go bad. So that's why we put in place a US LLC to act as the general partner. Now, the good news is a US limited partnership, which you can see here is owning multiple properties, A, B, and C, is considered a flow through for US purposes. What that means is that both Canada and the United States recognize a US LP as a genuine partnership. And therefore, any income and taxes paid in the United States would be credited to you on your Canadian personal tax return. So let's take an example. Let's assume that the partnership earned a profit of $10,000 US in the year. And this is from rents net of expenses. Let's further assume that you have no other source of US income, so you would be considered a low income earner for US purposes. So your effective rate would be quite low in the US, let's say 10%, okay? In Canada, let's further assume that you are working, you have a full-time job, and you're in a higher bracket, 40%, let's say. So how does the math work? Well, you will pay 10% of $10,000, which comes to $1,000 to the IRS, that's US income tax. And then in Canada, you will pay 40% of that same $10,000. Now I'm assuming the exchange rate is 1-to-1 for simplicity, which comes to $4,000. Now you're going to tell me, Allan, I'm double taxed. I've just paid $1,000 to the IRS, and now I'm paying another $4,000 to the CRA. Well, the good news is you will get a credit on your Canadian return for the US taxes already paid. So in essence, you would owe the difference in rates between the IRS and the CRA to the Government of Canada. That comes to about $3,000 or 30% in my scenario, okay? You'll also see in this example that the partnership has more than one property. It's okay for this partnership to own multiple properties. Now I'm going to look at this exact same diagram, but with a little bit of a twist. So it's the same scenario as above. We have our Canadian individual on top, who's a 99% limited partner, a general partner, which is represented by the orange box, a US LLC owning 1%. But you'll notice a bit of a difference. Under the partnership, rather than having the properties directly held by the partnership, I've created these black boxes, or US LLCs. So in this case, the LLCs are the ones that own the properties, and the LLCs are in turn owned by the partnership. Now, for US purposes, these LLCs are considered disregarded entities. Well, what does that mean? That means that the LLCs do not pay any income tax. As a result, any income or expenses are reported by the partnership. Okay, so let's suppose that you have 3 properties, A, B, and C, 3 different LLCs. Any income or expense derived would be captured at the partnership level. Okay, now the LLCs, as I said, are not tax-paying entities. However, they will have their own bank accounts. So that means each LLC would have an operating account. Any rent collected would be paid into that operating account, and any expenses would be paid out from that account. For tax purposes, as I mentioned, all of the income and expenses are reported at the partnership level. So that's the main difference. Now why is this diagram with the LLCs better than the previous one? Well, it's a concept of risk mitigation. Should one of the properties fail, the other properties won't be impacted because they're in their own separate LLCs. So this is a really good risk mitigation strategy. Like with the first structure, in this one, the second one, you're not double taxed. So that's obviously very good. Now, the partnership always has to have its own bank account. That's because when you, as the owner of the partnership, want to receive a cash distribution, the LLCs will pay up the cash up to the partnership and then to you in Canada. I often get asked the question, well, you know what, why don't I just keep the cash with the LLCs or with the US partnership and not take any distributions? Can I avoid paying US tax in that particular case? The answer is no. You pay tax on the income allocated to you and earned by the partnership in the year. So you cannot defer the incidence of taxation by keeping cash within either the LLC account or the partnership account. I'm going to move on to one more structure here. Before I do that, I've sort of listed the forms. I'm not going to bore you with them, but these are the various forms and the due dates with respect to the entities and what they have to file. And I'll be sharing that with our hosts, and they're more than free to distribute that if they would like to. So let's look at diagram C. Actually, let me, not diagram C, I want to pull you to another one here. Let me keep scrolling. Here we go, diagram D. So you'll see on top, we have a Canadian corporation. That Canadian corporation can be owned by you, jointly with your spouse, or multiple investors. That's a decision that you can make. The Canadian corporation owns shares in this orange box, which is a US C corporation. In the US, corporations have different classifications, S and C, so this is a C corporation. Underneath the corporation, we have these black boxes, which are US LLCs, and the US LLCs own US real estate. So I think it's easier to help understand this through an example. Let's say, for example, we have 2 properties underneath the black LLCs, property A and B. Collectively, they've earned a profit of $100,000 for the year. Great. Okay. So that $100,000, again, is not taxed at the LLC level, but instead it's the USC corporation that has to report the income and pay taxes. The effective rate in the United States corporately, well, now that Biden's here, it might increase, but it's 21%. okay, 21%. And that was reduced from a high of 35% under the previous administration. So having said that, let's suppose that in my example, that collectively the corp has earned $100,000 from its LLCs. So now at a 21% effective tax rate, that would be 21% corporate tax, or $21,000. The corporation is now left with $79,000. If the funds are kept in the corporate account, there's no further taxation, period. Okay, so it's a good tax deferral strategy. You could then reinvest the $79,000 into other LLCs to grow your portfolio. With the previous example, with the partnerships, as I mentioned, you have to pay tax in the year on the income earned, regardless if you received a cash distribution or not. So with the previous example, with the partnerships, you do not have the ability to defer tax at all. With this, you do. But what happens if you want to bring the money back to Canada? Well, let's take an example where all of the $79,000 is distributed back to Canada. First, there will be a 5% dividend withholding tax paid to the IRS. So 5% of $79,000 is approximately $4,000. That leaves $75,000 available for distribution. So the US writes a check, the US company writes a check or a wire transfer to the Canadian corporation for $75,000. That $75,000 is tax deductible for the Canadian corporation. So in effect, the Canadian corporation, which is a holding company, does not pay tax on the dividend received. So far, you've only paid about $25,000 in tax. If the dividend remains with the Canadian corporation, there's no further taxation at the personal level. The Canadian corporation could reinvest that money maybe into Canadian real estate, stocks, bonds, mutual funds, whatever. But if a dividend is paid up at some point to you as an individual from the Canadian corporation, that dividend will be classified as an eligible dividend. There are two types of dividends, eligible and non-eligible. Eligible dividends have a much lower tax rate. For me to give you the exact amount of tax payable, I would have to know your personal sources of income and then punch that into a calculator along with the eligible dividend received in order to calculate your total tax burden. Having said that, with this structure, you are not double taxed. So as I mentioned, with this structure, you have liability protection as you do with the others, but the bigger advantage is you have the ability to defer tax. There is a drawback. With this structure, you're not going to get capital gains treatment. When a property is sold for Canadian purposes, essentially only half of the gain is taxable. And the capital gains tax rate for each dollar of gain is effectively 26% at the highest level. But with this structure, you can't get capital gains tax treatment. Every dollar of gain is fully taxable. That's the major disadvantage of this structure over the other ones. If you're investing in properties that don't have a lot of appreciation potential but generate really high cash flow, then this is a good structure to go. However, if you're in the business of buying properties that generate a moderate or maybe high cash flow, but there is that upward potential for appreciation, then I think you should go with the partnership model. One last thing I'll add is a family trust. I don't have it visible in the diagram, but a family trust can be added to any of these structures. And the benefit of using a family trust is really to minimize estate taxes. No one wants to pay it. You have to pay the piper when you die. But with a family trust, we can mitigate estate taxes. That's the main purpose of it. Now, there is a catch with the family trust. Within 21 years, any assets or shares placed in the trust must be transferred out to the beneficiaries. So let's say you're married, you have a couple of kids, and your children 21 years later are now in their 30s, let's say. They're mature, responsible adults, and now you decide to transfer your assets and shares to these children. You're comfortable, you have enough assets to survive comfortably. So those assets and shares would roll over to your children from the trust on a tax-deferred basis. So your children wouldn't pay tax until the properties are sold or the shares of the companies are sold or until they die. So it's an excellent estate tax minimization tool. And I've set it up for my family. Why wouldn't I, right? I don't want to pay estate tax when I die. That pretty much summarizes it. Are there any questions or anything I can share?
No, great, for sure. We're gonna get to the Q&A. Me and Ava had a list of questions here for you, if we can quickly.
Sure.
Yeah, thank you for sharing that, Allan.
My pleasure.
Fantastic.
Yeah, I definitely appreciate the diagrams, and if you share that with us, we'll share that information with everyone who
Yes.
who was on the webinar today. So more than
Will
happy
do.
to have that for everyone. But
Thank you.
yeah, so maybe we can go ahead here.
Okay, fantastic. So Allan, thank you for sharing that. And I want to take a step back initially and discuss the concept of accounting or accountants. My parents are accountants, and they've been accountants for actually 30 years. But when we start talking about cross-border taxation and other tax strategies, it was like basically speaking another language to them.
Sure.
So could
Sure.
you quickly discuss the difference between accountants and tax strategists?
Right. No, thanks for the question. That's a really good question. Whenever you're interviewing an accountant, especially if you're investing in real estate, the first thing I would ask them, are you a real estate investor yourself? There's a difference between knowing something in theory as opposed to getting your hand and feet sort of wet, so to speak. The second thing I would ask them is, do you have experience with cross-border taxation? How many clients do you have, in real estate, and have you set up these structures? Do you work with these structures? And can you help me formulate a plan where I can avoid double taxation, defer tax, and minimize estate taxes if possible? So those are really the pointed questions that you should ask, or what I would ask if I was interviewing an accountant.
Thank you.
Great, wonderful, awesome.
Great
So I have a question here for you, Allan. So our group focuses on investing in the U.S. and we'll get into cross-border taxation in a moment. And you had great diagrams there we talked about. We'll have some questions there for you. But I want to focus on taxes related to real estate investing on this side of the border for Canadians. So my background is in construction and development. Could we briefly talk about what tax strategies exist? And so in particular, when it comes to real estate active investors or real estate developers, when they buy a real estate asset, they add certain type of value. If it's a renovation, if it's a building a project, if it's developing project, what kind of taxes are there? What kind of tax implications? What are the great structures to be used for local active real estate investors? And then we can make a comparison to the US parts of that.
Sure. So let's take an example of an individual who'd like to buy a property, perhaps that needs some work, and they're going to renovate it and then sell it for a profit. That's considered a flip, and you are now in the business of trading real estate. What I would suggest that you do is, first of all, incorporate the business. Two reasons. Number one, you want to shield yourself from any personal liability if things go wrong. The second is taxation. Canadian corporations pay a very low rate of tax on active business income. Profits from flips are considered active business income. In fact, in the province of Ontario, the rate is approximately 12%. That's the combined federal and provincial rate on business income up to $500,000 per year. The second thing I would be careful about is financing, to make sure that you're working with someone who can ensure that the mortgage is arranged with the corporation. You'll likely have to give a personal guarantee, but that's fine, that's expected. And third, a lot of times individuals don't realize the HST implications. If it's considered a new build or new construction and not the resale of residential real estate, then HST applies. The buyer is going to say, well, I don't care, I'm just paying fair value for the home. The market price is the market price. And so that 13% HST is going to come out of your pocket, and that could really kill your margin. So one trick to be noteful of is that renovate the property less than 90%. So if you look at the floor space, keep one room aside so that you're below 90%. If you have renovated the property less than 90%, then it's not considered a new build. And as a result, it's considered the resale of residential property. And so HST would not apply to the sales price.
Okay.
Got it. Great.
Now I kind of want to dovetail. I'd like to dovetail and discuss tax benefits that exist in the US, such as the 1031 exchange.
Yes.
Briefly touch on what the 1031 exchange is, and if you may, and we do have something, and if we have something similar in Canada.
Exactly. Yes.
Right. So the 1031 exchange is a great tool for real estate investors. in order to defer capital gains tax. So long as you buy a replacement property within a specified time period, you can defer the capital gain that you made on the sale of the property. However, if you're a Canadian resident, that gain is still going to be recognized as taxable in the year. Only half of the gain is taxable for Canadian purposes. Having said that, I wouldn't recommend a 1031 exchange for a Canadian investor in US real estate, because you're still going to have to pay the tax in Canada on that gain. So there's really no point. And unfortunately in Canada, we don't have any similar provisions to a 1031 exchange.
Got it. And that's what we've noticed. And one of the reasons, the impetus for us wanting to invest in the US is because so many tax benefits that exist, and the business friendliness of so many states, and also many other items. Another quick question here for you, Allan. Thank you for that. Is we had a good friend 𝗖𝗽𝗶𝗁, who is an expert in cost segregation tax savings that exists in the US. Where at the time of purchase a multifamily asset, for example, you could use certain tax benefits when you show depreciation in value of certain material used in the structure. For example, the roofing material or plumbing and what have you. Is cost segregation a common tax strategy that is used?
It is. So you want to itemize the, when you buy a multifamily property, there are other things there. There's carpets, there's appliances, there could be furniture and fixtures, roofs, of course. So you want to itemize these different categories. Certain categories, without going into too much detail, have a higher depreciation rate than other, and that's the concept of cost segregation.
Got it. Great. And this question was for you, but maybe I can jump in here, if you're okay. So yeah, we noticed on your YouTube channel that that when the US, and we had a question about this earlier as well, when the US dollar was at par with the Canadian dollar, a lot of Canadians started investing in the US, but we're talking about a smaller investor, somebody who's looking to buy a house in Arizona or so we noticed that you actually had recorded YouTube videos in that time to help Canadians invest into US real estate, and you spoke about different strategies that exist. Now let's kind of switch that up about the passive investor. So the concept that we promote and the investors we partner with are all investing passively. So we're the brains of the operation. We find the project, we manage it, we force appreciate it, and we eventually exit it. And our investors are the limited partners, are the investors within the project. Now, as far as the benefits that exist, kind of discuss that with us as well. So are there strategies where someone could invest passively? So also another thing we noticed is we talked to a lot of US active investors, US sponsors, operators, and their reach comes all the way across the borders. So bigger groups where Canadians are looking to invest with them, but when they go to invest, they're like, hey, we can't take your money unless you have a US LLC. But if they invest through the US LLC and eventually those funds come back to Canada, or they're receiving the distribution, they're going to get double taxed. So are the points that you showed and the pages that you showed earlier, could those also be used for a passive investor who is not part of the actively involved in operating the business? Can they use these strategies that you mentioned as a passive investor?
Absolutely, they can. So let's look at the partnership structure, which is very common for passive investors. Let's say they own 10% of the investment portfolio that's underneath the partnership. So they would simply receive a K1 slip, which is a partnership income slip from the US partnership.
Sorry, Allan, do you have that? Could you share your screen again, and maybe you can point to what you're doing as you speak it? So I think that'd be great value for.
Sure, no problem. Let me just share it.
Take your time.
No problem. So let me go back to the beginning. Right, so here we are. So the partnership represented by the blue triangle, let's say instead of 99%, the Canadian individual has a 10% interest in the partnership as a limited partner. They're not actively involved, they simply want to receive their check. So in this particular case, the partnership would produce what's called a K1 slip, which is a partnership income slip for their share 10% of the partnership income in the year. That K1 slip is then attached to a US individual tax return called a 1040 NR. The Canadian individual investor would file a US individual tax return and then pay US income tax based on a very low rate if that's their only source of income. They would also use that K1 slip with a couple of adjustments for Canadian tax purposes to report the income on their Canadian return. As I mentioned previously, they will not be double taxed because they can claim a credit on their Canadian return for the American taxes paid.
Great, perfect.
All
I'm
right.
happy we had that, got that out of the way.
Yeah, definitely. That's a good one.
So
Now, Allan, you know what? I would love to discuss this tax treaty that exists between Canada and the US, which allows
Right.
Canadians to invest in US real estate and be relieved from the double taxation, which you were kind of
Yeah.
talking about. So maybe you could talk more about this,
yeah, and
this treaty.
for
that
sure,
exists.
for me to jump in, sorry,
Of
Eva, I
course.
always jump in. I get so
You get so
excited.
excited.
I
That's
jump
good.
into
That's
it
good.
while you're asking a question. But so all the items that you're mentioning and the structures that you talked about are all governed by obviously Canadian law and US law. And
Yes.
what brings these two laws together and allows for such investing to happen is the treaty that exists between Canada and the US. So what we notice is a lot of investors are concerned about that. Hey, I'm already concerned about dealing with CRA. Now I got to deal with the IRS, and nobody wants to have any issues with the IRS.
Yeah.
So yeah, talk to us just on a high level about the existence of such treaty and
Sure.
yeah, if you may, please.
Well, I wouldn't be nervous, first of all, and I can understand the apprehensiveness if someone has never filed a U.S. return before, but it's quite simple. It's simply a statement of income and expenses. Essentially, in the case of a partnership, just one simple partnership income slip. So there's nothing to worry about. It's fairly straightforward. But going back to the tax treaty, you're right. We do have a double taxation agreement with the United States, and that's precisely there to prevent double taxation. And as you can see, we can claim foreign tax credits to avoid double taxation. In the corporate structure, we can also take advantage of the reduced dividend withholding rate when dividends are paid up from the US C Corp to the Canadian parent. Instead of 30%, it's 5%. So there's a multitude of benefits that we're taking advantage of due to the tax treaty between the two countries.
Wonderful, great. And I just shared Allan's LinkedIn profile and his email address. If
Sure.
anyone likes to get in touch with Allan, that's his information. And please come on in. If you have any questions to ask, please write it in the Q&A box, and we'll get to them in a moment. Please go ahead and ask them. I think earlier there was a question about. There was a question about implications of the exchange rate, and I kind of jumped in and answered a question for our viewer here, and that was that in our firm, when an investment happens with our group is in US dollars. So throughout the whole lifespan of the investment is looked at as a US dollar investment. So could that have implications when it comes to the exchange? Yes, it does. But the investor needs to look at their investment as US dollar from day one to when they exit the asset. So if you have a quick comment about that, Allan.
Well, I mean, if you have an exchange gain, that's great, right? That just means you made more money for Canadian purposes, because when you bought the investment, the Canadian dollar was higher, and then when you sold it, the Canadian dollar was lower, right? So you've actually profited. You got more Canadian dollars. So no reason to worry about the exchange gain. If you make money, great. That's all the power to you. But really, the Canadian dollar trades within a reasonable bandwidth, notwithstanding unforeseen circumstances. So I wouldn't really worry about it.
Okay, fantastic. Now we have another question here. So if we were investing with CPI, would we need to create one of these legal structures, or would CPI structure be enough? That's a great question.
Yeah, no, it's a great question. So with CPI, we tried our best to allow for the process to be as streamlined as possible, and also for our group to be very inclusive. So we raise from non-accredited investors. Our minimum investment is $10,000. We're also offering to actually file for our Canadian investors US taxes, and we were in communications with Allan, getting a code from him for all that.
Yeah.
The investor would need to pay for those fees.
So it's very, very simple. CPI has their structure set up, and you literally just invest as a limited partner. And
you invest as a limited partner on this side of the border. So you receive your limited partnership shares. And that limited partnership, the capital then goes through a web of corporation and limited partnership, similar to the graphs that Allan shared. And then on our distributions coming back to Canada, they're structured a different way, again, for tax savings. They're return of capital rather than they're seen as return of capital. So there's no tax on the quarterly distributions coming back. And at the time of sale, again, we use the flow through limited partnership. So it's a bit more complicated. There's a bit more items involved, and it doesn't really make sense for the cost of it for an individual investor who's looking to buy a house buy a house or a condo in the US and then invest. But it makes sense when we're partnering with hundreds of investors to buy a $50 million asset. It makes sense to have all these webs of corporation to make the process of the flow through much easier for the investors.
So to answer his question, no, you do not need to create your own legal structure. We do all that for
exactly. You. Thank you. You always simplify things.
I like to
Ava.
simplify things.
So we'll just maybe should we ask our own question and jump back to our guests, our viewers' questions, or?
Yeah, there's one that we were kind of a investor just reached out to us, and
yes.
it was in
great.
Becoming a kind of a common question is that, Allan, when it comes up when there's dual citizens who live in Canada but are investing in the US, so how are they taxed, and do they need to file taxes on both sides of the border as well?
Sorry, could you repeat the question? It's my little daughter. She just came in and she was having some homework lessons. I'm sorry. Could you repeat that question? I apologize.
We'll talk about kids because you'll get Ava going over here. She loves kids.
So another very common question that we noticed comes up lots is dual citizens who live in Canada but they're investing in the US.
Yes.
How are they taxed, and do they need, now because they're dual, do they need to file taxes both in Canada and the US?
They do need to file. So being a citizen of the US is a major privilege. The disadvantage is, from a taxation perspective, is that regardless of where you live, you will always have to file a US tax return and pay US income tax on your global income, but you're not going to be double taxed. In Canada, as I was mentioning, if you're living in Canada as a US citizen, you're also considered a Canadian resident, which means you're taxable on global income. But with this structure, whatever tax that you pay in the United States will be credited to you on your Canadian return, and you'll only be paying the difference in rates between the Canada Revenue Agency and the IRS to the Government of Canada. So you are not double taxed.
Great.
Okay,
wonderful.
fantastic.
We appreciate that. We have another question. Allan, could you see the questions in the Q&A box by any chance? We have a question from Grace.
And I'll read it out for everybody too.
Sure.
So,
yeah, go ahead. Sorry about that, Ava.
Grace says, when setting up a Canadian corp and a US corp structure, can that be set up by the same person? They say have a dual citizenship and are able to do that.
Say they have a dual citizenship, and are they able to do that?
Correct.
So if the individual is a dual citizen, I wouldn't recommend creating a Canadian holding company, as I showed in my previous example, that owns shares in a US company. The reason being is you will be double taxed. Without going into many details, Canadian holding companies that are generating passive income are considered passive foreign investment corporations, PFICs. And there's a bunch of rules that apply, but essentially you could be double taxed. So for you, a partnership structure would be better because that's considered a flow through on both sides of the border, and it's not a corporation.
Okay.
Great, wonderful. Please, we are done our questions from Allan. We'll love to have him on again, but if you have any questions, please write it now, and we're going to close with with the same questions we always.
Two famous questions that we always ask.
I don't know how famous they are, but our two definitely favorite questions. Yeah, so we're waiting here. So yeah, I guess we'll go ahead and ask those questions.
Yes.
Yeah.
Okay, so Allan, here's a question for you. What would be your number one advice to passive investors? And when I say passive investors, of course, I'm talking about people who don't want to be involved in the day-to-day operations of the business, but rather want to be limited partners.
When they want to invest in a cross-border situation, what would be your advice to them? What should they look out for, especially if they're looking to partner with a GP like us who manage the project? What should they look for? What should they watch out for? What should be the list of things that should
your number one advice?
Sure. No, I appreciate the question. I would just have an honest conversation about the GP, the principals, their experience, what their investment model is, and does it align with your objectives? You just want to make sure that you're on the same page in terms of what your expectations are and what's being provided. That's really what I would do.
Great answer. Now, on the opposite side, this is the second question we ask our guests is, what is your number one advice when it comes to active investors? People who are either starting out or they're mid-level investors looking to either invest in cross-border or even here locally in real
Sure.
estate, what would be your number one
As,
advice?
as an active investor, a passive investor, it's always a great idea to partner with someone who does have experience and has this structure set up. So that way you don't have the headache. You can learn from them and leverage from them. And then if you want to invest more, or you want to go on your own, or whatever it is you want to do, at least you have that partner resource there. That's what I'd certainly do.
Great.
Okay,
Awesome.
fantastic.
That's wonderful.
Well, Allan, you are a genius when it comes to
I appreciate that. That's so kind of you to say.
And
everything
we
else.
weren't even expecting that you were gonna have graphs and diagrams, but we really appreciate that. We can't wait to have this on our YouTube show. We appreciate everybody
Sure.
coming on.
And might I say, everybody check out Allan on his YouTube channel.
Absolutely.
Yes, I've gained a little bit of weight since, so no comments on that. I have to delete those. So.
But you've been so consistent that you've been doing it for such a long time, and that's what we loved about
Right.
you. And your focus is so broad. You touch on so many different subjects. We're on focusing on this cross-border item, but your YouTube channel is excellent place to be, to get information, and especially when it comes to Canadian.
I appreciate that. I appreciate that.
Much respect for such an intelligent man.
Thank you so much.
Thank you
for
joining
your time.
us today, and thank you everybody for coming.
Have a
we
wonderful
appreciate
day.
you all.
Thank you.
Thank you.
Bye-bye.
Okay, take care.